Welcome, ladies and gentlemen, from me, Guy Monson, Chief Investment Officer of Saracen Partners, to our regular weekly strategy update. I've begun this report by looking at the social impact of the COVID-19 virus and the accompanying lockdown measures, which have hit the global economy so extraordinarily hard. I've used the US report by Chairman Powell's Federal Reserve to Congress and the Senate, where he looks at the impact of monetary policy. He's just filed this. In there, he unusually highlighted that while job losses have been pervasive, they've been particularly aggressive for lower income groups. In that left-hand panel, you can see the top tier of income groups largely unaffected. The bottom tier seeing 30–40% declines in employment. On the right-hand side, women have suffered more than men, the young more than the old, the lesser educated over the more educated. Look at how little drawdown there's been if you've had a bachelor degree or higher, and minorities suffering over the core population. This is going to become, and is already, a huge issue for policymakers, and has been a factor behind some of the protests that we've seen around the world, accompanied, of course, by the Black Lives Matter agenda. What will governments do to respond? Well, first of all, I think they'll accelerate the opening measures if at all they can. And that's what we're seeing in the global stringency indicator. You can see that Italy is the first country now to move below the 50%. In other words, more than 50% of measures have now been lifted. And the general trend is downwards. Note, though, the warning signal of China in light blue as the virus re-emerges in Beijing and the tough lockdown they've had to have. That's had an impact on the economy, and you can see slightly more spotty numbers out of the Chinese indicators. While industrial production, for example, mostly state-led, is quite robust, retail sales are relatively weak. Interestingly, steel production at an all-time high, but fixed asset investments still relatively weak. The second measure will be to continue to keep up the tempo of these huge fiscal programs, whatever, to some extent, the cost in terms of borrowing, as we saw in the UK this week. In the US, interestingly, the impact of the directly mailed checks from governments to individuals has actually been to lift US disposable income, with 60% of those unemployed having received income support greater than the income they've lost. This is quite encouraging because it has meant a relatively aggressive rebound in retail sales. Now, still down sharply, down 6%. But the month-on-month number for May was the greatest since the index was recorded. And we're beginning to see these trends around the world. Interestingly, spending on home improvements and autos, perhaps as people travel differently from home working, the lion's share of the spend. The third factor I think you'll see is continued determination by central banks to increase asset purchases. We're now almost reaching $20 trillion for the major world central banks' balance sheets. That's been rising at almost 3 times the rate we saw out of the 2008-9 crisis. And as you can see on the right, there is a lot more spending still to come from the Federal Reserve. The Bank of England, in a smaller way, added to this spend when it announced $100 billion of extra government bond purchases. Interestingly, Andy Haldane, the chief economist, voted against that, and they did time date it, which slightly limited the impact in markets. In fact, we saw gilts initially sell off, but the trend is clear. All of this is particularly necessary because inflation has slipped alarmingly low. Now, some of that will reverse with oil prices, but you can see in the US, the CPI almost reached 0. The core inflation better, but still at 1%, far lower than the Federal Reserve would like, and very similar numbers in the Eurozone, putting huge pressure on these central banks if they want to re-stimulate growth to avoid a deflationary trap. Turning to the UK itself, we're a microcosm of these social challenges with the extraordinary correction in GDP, the horrible, I'm afraid, number of minus 20% in April after a fall of 5.8% in March. Unprecedented even in wartime. You have to go back to the Great Depression or earlier. That's also occurring at a point of very low inflation, which means a deflationary trap is easy to fall into. That has meant that the vast furloughing programs covering about 9.5 million workers for the furlough itself and another 2 million or more for the self-employed, will continue to weigh very heavily on government finances. We had a dramatic month's borrowing, minus 54 billion of borrowing in a single month, the largest we can find anywhere in history, and that will continue to mount. The ONS saying UK debt already at 100% of GDP for the first time since 1963. Now that's alarming on the one side, but it is stabilizing growth on the other. The other factor that's modestly encouraging is perhaps the pressure on governments will lead to slightly more proactive political solutions. We've seen slightly better news on China-US trade. We've seen the push by the EU to instigate its aggressive 750 billion fiscal program. And perhaps even on Brexit, we may be seeing a slightly better tempo. After Johnson's meeting with Ursula von der Leyen and other leaders in the EU Parliament, etc., I took one particular phrase out of their press comment. On the agreement, they stated in the latter part of the paragraph, this should include, if possible, finding an early understanding on the principles underlying any agreement. In other words, giving us a hint where we're going so businesses and individuals can prepare. It's a small grain of sand, but it's a better tempo. Overall, our two key indicators relatively stable. A little dip down in the US treasury rate expectations, not yet at anything like danger levels. And those Eurozone spreads, very, very much tighter, a very reassuring result from ECB and EU action. So this adds to momentum in financial markets. The world index up 37% from its low, back to break even and a little bit more in sterling terms. Gold rallying a little bit, gilts rallying a little bit. That sharp sell-off we saw last week, to an extent reversed. Volatility, which peaked at over 40, back down now for the VIX to the 30 level. So for the moment, social tensions and social pressure argue for proactive central banks, aggressive spending by governments, and perhaps a slightly better political tone on trade and other issues. That is broadly supportive, at least for the present, for risk assets, and argues for interest rates and gilts to remain low for longer and longer. Thank you.